Welcome to the channel, where we talk about trading, not as a casino, but as an intellectual discipline, a space of deep psychology and calculation. Today, we will shatter the myth of guaranteed profit, and replace it with the concept of a guaranteed process, which is the only true path to sustainable success. Many come to this market expecting quick financial magic, but they face only the brutal reality of losses that quickly destroy faith. In truth, trading is a marathon, not a sprint. And the first step is accepting this truth, casting aside all marketing promises. We will focus on three fundamental pillars that will allow you to survive in the market and, most importantly, start earning consistently. At the start of the journey, most beginners ignore the most important thing. Trading is a business, where your capital is the raw material, and risk is the operating cost. They look for the perfect indicator, or a secret strategy, while the real advantage always lies in internal order and a systematic approach. The emotions of greed and fear become the greatest enemies, forcing traders to make irrational decisions at the most critical moments. If you cannot control yourself, the market will control you, draining your deposit to the last cent. Therefore, before opening your first trade, it is essential to create a mental framework capable of withstanding the pressure of price fluctuations. Many believe that success depends on the ability to predict movement. But this is an illusion. No one knows where the price will go in the next second. Success lies in the ability to respond effectively to the unpredictable, managing probabilities and your own resources. The first step to profit begins, not with buying an asset, but with a clear definition of how much you are willing to lose in the worst-case scenario. If you cannot sleep peacefully after opening a position, your risk is excessive. And this is the first signal to review your strategy. This is the psychological depth of trading, a struggle not with the market, but with your own instincts. Our first fundamental step is a deep understanding of liquidity, the oxygen of any financial market. Liquidity is the ability of an asset to be quickly sold or bought, at a price close to the last traded price, without significantly affecting its quote. When liquidity is high, you can easily enter or exit a position, minimizing the slippage that can eat your profit. Conversely, low liquidity turns trading into a minefield, especially for large volumes, where a single order can cause a sharp price spike. Beginners often make the mistake of trading obscure assets, just for their high volatility, forgetting the critical aspect of trade execution. Liquidity directly shapes the market structure, determining how smooth or jagged the price chart will be. In highly liquid markets, such as major currency pairs or stocks of large corporations, orders are closed almost instantly, providing the trader with predictability. In low liquidity markets, however, order execution may occur at a price significantly different from what was expected, especially during rapid movements. This phenomenon, known as slippage, is a hidden tax on trading illiquid assets, often ignored by amateurs. Understanding market depth, the volume of orders at different price levels, allows you to assess whether your order can be absorbed by the market painlessly. Essentially, liquidity shows exactly where the interest of the big players, those who actually move the price, is concentrated. They do not trade micro lots. Their multi-million-dollar positions require deep liquidity for effective execution, so they leave footprints on the chart. A conscious trader always looks for places where large volumes have accumulated, because these levels will later act as strong support or resistance. Trading against the direction set by institutional investors is a losing game, regardless of how perfect your technical analysis is. You must become like a shadow of the big players, seeking where their tracks are clearest, rather than trying to walk against this powerful current. We move to the second fundamental pillar, risk management. And this is not just a set of rules, but a philosophy of survival. If liquidity is the engine, then risk management is the braking system that prevents you from flying off the track at the first turn. Most traders focus on potential profit, but professionals always start by defining the maximum allowable loss per trade, and per day. The golden rule of survival is this: never risk more than 1%, or even 0.5% for beginners, of your total deposit on a single operation, no matter how attractive the situation seems. This 1% is your insurance premium for participating in the market game, and its loss should not cause emotional pain. It is necessary to clearly distinguish between the concepts of risk and volatility. Volatility only shows how quickly the price changes, while risk is your personal financial decision. Position sizing is critical. You should not use the same volume for a trade where the stop loss is 20 pips, as for a trade where it is 100 pips. The position size must always be calibrated, so that, regardless of the width of the stop loss, you only lose that same 1% of capital. Only this approach guarantees that a series of inevitable losing trades will not destroy your account or your psychological resilience. Ignoring this rule is the most common reason for blowing deposits among beginners. A key element is also the risk/reward ratio, which must be higher than 1 to 2, or 1 to 3, to have a mathematical edge. Even if you are right in only 40% of your trades, at an R2R of 1 to 3, you will remain profitable, because your wins will cover and significantly exceed your losses. This shows that success does not require 100% accuracy. It requires consistency and discipline in fixing both profits and losses. Never let a small loss turn into a disaster by moving your stop loss further away in hopes of a price reversal. That is an act of despair, not calculation. Remember, your stop loss is always a fixed boundary, set with a cold mind before entering the position. Discipline is the third and, perhaps, most important pillar, because it transforms strategy into real results. Without discipline, even an ideally designed trading plan will turn into chaos under the pressure of market emotions and unpredictable news. Discipline begins with creating a written trading plan, a detailed document describing when, what, and how you trade, and most importantly, when you do not trade. This plan should be your Bible. Deviation from it is unacceptable, despite the inner voice whispering about easy money. For example, if your plan forbids trading before major economic data releases, you must follow this rule, even if you feel you know where the market is going. Your trading plan should contain clear criteria for entry, exit, and fixing loss or profit, leaving minimum room for subjective interpretation. Emotional trading always arises where there is uncertainty, so the more detailed and mechanical your rules are, the easier it is to maintain discipline. For example, if you see a perfect buy signal, but it occurs at 2 in the morning, and your plan only allows trading during European session hours, you must skip that trade. Success in trading lies in the consistent execution of mediocre trades, not in trying to catch unique rails. It is routine, yet necessary work that requires absolute psychological stability. One of the key practices of discipline is maintaining a trader's journal, a detailed record of every operation, its reason, and your emotional state during the trade. The journal is a mirror in which you see your real mistakes, not the illusions your brain creates after losing money. It allows for an objective analysis to determine which strategies work in certain market conditions, and which only drain your capital. If you cannot explain exactly why you entered or exited a trade, you are not trading, you are gambling, and keeping a journal will quickly expose this dangerous tendency. Working on the mistakes recorded in your journal is the most effective way to improve your trading skills. Moving to a deeper understanding of liquidity. Beginners must learn to identify so-called liquidity zones on the chart. These are price levels where the largest cluster of stop-loss orders is expected. Levels that big players hunt to fill their own positions. If you see a clear horizontal level where the price has bounced several times, it is likely a place where many retail traders have set their protective stops. Large banks and funds need this volume of liquidity to execute their massive orders, so they often sweep these stops with a sharp move, before starting the movement in the true direction. Realizing this mechanism allows you not to become a victim of these price manipulations, but rather, to take advantage of them. You must learn to read volume, not just as an indicator, but as a confirmation of large capital's interest in a certain level. A sharp increase in volume at a specific price level, accompanied by a strong move, indicates that a battle took place between buyers and sellers, and one of them gained a significant advantage. You must ask yourself, was this volume absorbed, or did it cause a breakout? And only after that should you decide to enter. If the price breaks through a strong resistance level on low volume, it is often a trap, indicating a lack of real strength for further movement. It is this attention to volume dynamics that separates professional analysis from amateur guessing. The main mistake regarding risk lies in the psychological resistance to accepting a loss, which is a direct consequence of breaking discipline. Many hold a losing position hoping for a return, instead of fixing a small loss and preserving capital for a better trade. Remember, your capital is your tool, and its preservation is the primary task, more important than any specific trade. A true professional perceives a stop-loss hit not as a defeat, but is confirmation that the market does not currently match their expectations. This means the risk was correctly limited. This ability to emotionally detach from the outcome of a trade is the cornerstone of a trader's psychological resilience. Let's talk about the importance of backtesting, the process of testing your trading strategy on historical data to assess its mathematical edge. Backtesting does not just check if your strategy would have worked in the past. It gives you the statistical confidence that it has a positive mathematical expectation for the future. You should carefully analyze at least 100 to 200 trades to obtain statistically significant data on the win rate and the average R2R of your system. Without this data, any trade is a blind gesture, based on assumptions, not hard facts. Only when you know for certain that your system has stood the test of time can you trust it with your real capital. It is important to understand that backtesting must be realistic, including all aspects of real trading, commissions, slippage, and psychological lapses. Many beginners conduct an idealized backtest where every trade is executed at the perfect price, which inevitably leads to disappointment in the real market environment. You must account for the fact that even the best strategy will have a series of losing trades, and your task is to estimate the maximum expected drawdown to mentally prepare for it. If your system shows it can have 8 losses in a row, you must be ready for the 9th without deviating from the plan. This is the true meaning of discipline, following the plan even when it seems ineffective. The risk we talked about earlier also includes capitalization risk, choosing the right account size for your strategy. If you trade a strategy that requires large capital to cover margin requirements, and your deposit is too small, you are automatically exposed to the risk of a margin call. You must start trading with an amount whose loss will not change your life, and will not force you to make emotional decisions from a place of despair. Trading is a long-term game, and if you destroy your capital at the start due to excessive risk, you will lose the opportunity to learn and grow. Start with a small lot, but with large ambitions for learning. The first profit is often a psychological trap, testing your discipline by creating an illusion of invincibility. When you first see the system working, there is a temptation to immediately increase the risk to scale that success, and this is the most dangerous moment. Professionals know that consistency is much more important than the size of a single trade. It is better to have 100 small profits than one large one after which follows a catastrophe. Do not let success intoxicate you, making you forget the 1% risk rule you set with a cold mind. Keep the same position size, even when it seems the market is offering easy money. On the other hand, the first series of losses is a test of resilience, making you doubt the entire strategy and yourself. At this moment, when you feel deep disappointment, your brain begins to search for a new, better strategy, leading to what is known as strategy hopping. This is the worst decision, because you destroy the statistical advantage of your system without giving it a chance to work over a long distance. If your backtest showed positive expectation, you must continue to execute the plan, trusting the mathematics rather than fleeting emotions. Remember, trading is a game of large numbers, and individual trades mean nothing. To control discipline, it is important to introduce time and money limits on trading. This is called a stop loss on time and a stop loss on capital. If you have already taken 3 consecutive losses in a day, regardless of their size, you must immediately close the terminal and walk away from the screen. Prevent the urge to revenge trade. Similarly, if you have reached a predefined daily profit target, you also must stop, avoiding the risk of losing what you just earned due to greed. These rigid limits ensure that you do not turn a day of bad luck into a catastrophe, and do not succumb to hyperactivity after success. In the chaotic world of the markets, where fear and greed pull you in every direction, there is a voice from 2,000 years ago that offers absolute clarity. The Roman Emperor, Marcus Aurelius, wrote a private journal that was never meant to be published. Today, we know it as Meditations. This is not just a book of philosophy, it is a manual for the ultimate mental edge. It teaches you to separate what you can control from what you cannot. In trading, you cannot control the price, but you can control your reaction to it. You cannot control the outcome of one trade, but you can control your discipline. If you are struggling with the emotional pressure of the charts, or if you find yourself reacting out of panic, Meditations is the foundation you need. It is the original guide to Stoicism, and the secret weapon of the world's most successful, calm, and calculated traders. Learn to find stillness in the middle of the storm. The link to the book is below the video. In summary, Guaranteed profit in trading is impossible. But guaranteed success is achieved through unwavering discipline, clear risk management, and an understanding of liquidity. Your journey must begin with a thorough study of market mechanics, not with the chase for quick money, which always ends in failure. View every trade as a statistical event, not a unique chance, and then emotions will stop dominating your decisions. Only those who treat trading as serious, monotonous, but highly intellectual work will stand the test of time. Trading is a constant battle with yourself, where the market acts only as a mirror of your internal disorganization or, conversely, systematic nature. If you haven't learned to control your risk on a demo account, you are guaranteed to lose real money, because the fear of loss will only amplify your irrationality. Do not look for perfect entry points. Look for a consistent process and a system that has a proven mathematical advantage. Remember the words of the wise: the main task of a trader is not to make money, but to avoid losing it. So, 3 steps to your resilience. 1. Analyze liquidity, to know where the big players trade and avoid liquid traps. 2. Strictly follow the 1% risk rule per trade, keeping your capital intact. 3. Build iron discipline, through a detailed trading plan and a journal. This is not a promise of instant wealth, but it is the only way to build a profitable career in trading. A career based on calculation, not on luck. Thank you for walking this path of psychological depth with me. Subscribe, and remember, the market always gives a second chance, but it takes your capital if you haven't learned discipline. Until next time.